Hello, future billionaires. Welcome back to another episode of your favorite podcast, the Invest Like a Billionaire podcast. Today, we had a really fun conversation with Dr. Chris Liu. So he runs a podcast called Passive Investing for Physicians and really shared a lot of his story of how he kind of went from being an MD to retiring and becoming financially free through real estate investing. And so we actually took a fun approach on this interview where we do our Passive Investor Spotlight series. So we ask some questions. He shares kind of his story, but then really gets into how he's currently investing in his portfolio and where he sees some potential opportunities, shares just some of the mindsets that helped him kind of get to where he is. So definitely you got to check this episode out. Always fun to hear from fellow passive investors of what they're doing. And if you are enjoying this podcast, I would definitely encourage you to appreciate if you would subscribe to the podcast on any platform you like and leave us a review if you don't mind, because that really helps us get the word out and kind of gives us the credibility to continue to get the message to more and more people. So if you wouldn't mind doing that, appreciate that on Apple or Spotify, wherever you listen. I'll leave a review and hope you enjoy this episode. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Welcome back to the Invest Like a Billionaire podcast. I am your host today, Ben Fraser, and very excited to be bringing on Chris Liu onto the podcast. And I was actually just recently a guest on Chris's podcast, which is a great podcast to go check out. And he's got a really cool story. As we were kind of talking, I was like, hey, we got to have you on our podcast and kind of share some of the things you're doing, share your story. And so we're going to kind of take a fun angle on more of in our segment, in our show, we have a segment called Passive Investor Spotlight and really trying to understand more of the nuances. So I want to hear the story. I want to hear how you got to where you were. And you said you have a lot of different consulting and mindset shifts and things that you feel are really helpful for investors. But then would love to kind of, at the tail end of the interview, kind of go into more specifics of allocation strategy, where you see opportunities, et cetera, et cetera. But before we do that, Chris, welcome to the podcast and share a little bit about your story.
Yeah, I'm really happy to be on your podcast, Ben, and and I'm really happy to offer a lot of value. So I'm a physician by training, trained in orthopedic surgery from 2000 all the way up to 2016, and essentially transitioned. I was able to gain my financial freedom by investing in real estate from 2008 to 2016. Retired early, and I felt that there was a need for financial literacy and financial freedom and financial independence in the physician community. A lot of physicians were getting ripped off, scammed, didn't really understand the dynamics of debt, and they were getting themselves in trouble, and they were tied to a single income, which during COVID really exploded. So, I started Financial Freedom for Physicians in 2016, which is a media and consulting company dedicated for financial literacy for physicians, high-income earners, professionals, and so that they can create time, wealth, location, and health freedom in their lives and have more control. And so that's essentially my story. And, the interesting story, which I think a lot of listeners will be surprised, is, I had the traditional career all the way up. I followed all the rules. I took all the exams, got all the good grades, got admitted, and essentially everything came to a standstill in September of 2008 because I got fed up with the way the system was set up, and the system was set up to benefit only a few, and leave everybody else behind. So I turned in my keys, badge, and pager, quit my lucrative medical career the day Lehman Brothers collapsed, and set out, and I was going to create a life independent of the current system so that I can create my own time, health, wealth, location freedom. And since then, it's been a wild ride. It's been a wild journey, tremendous success, tremendous failures, and I'm happy to share all of that on the show.
Man, well, you just shared a lot. There's a lot to unpack. So yeah, rewind the clock a little bit. So kind of share the first aha moment, maybe, of when you saw the light of, hey, this actually could be a possibility that I could go and do this, create the time freedom through investing. And it sounds like that was kind of contrary to maybe the way you were raised, or that maybe kind of the schooling and the path that had kind of been forged for you and probably a lot of other people that were in that position, right?
Yeah. My aha moment really came, especially, it was first 2000, after the tech bubble, and then especially after 9/11 and, Enron, WorldCom scandals. So that was really my aha moment. Really, the world was changing. And I was fortunate to come across a book called Rich Dad, Poor Dad. I'm sure the majority of listeners have read that, but if you haven't, really read that. It's got a lot of the fundamental concepts of where our financial system is today and how to protect yourself. So that was my aha moment. And luckily, when I started medical school, Houston real estate was really cheap. It was actually cheaper to own a piece of real estate as opposed to rent. So, rent a 2-bed, 2-bath, 1,500 square feet was, back then was 1,500. And then you could actually buy a condo, decent condo for, 50, 60K. So, you're actually saving money by owning.
Wow.
That set me ahead a little bit. And my first success was when I rented out the other room to a fellow classmate. So I was basically, living rent free and, studying to become a doctor and all of that. So I was like, oh, wow, this is a good source of alternative income. And from there, I just, I got hooked because, real estate is a hard asset. If I could rent out these rooms, I could rent out more. The problem was with just finding funding. And, from there, I, got into house hacking and expanded from there.
Wow. So you were doing this on the side while still working full-time as a physician. And so did you start buying rentals? Did you start investing passively in syndications, or that kind of happened later on? Or what was kind of the journey there on the investing side?
Yeah. So I got my second property back in 2004. So, between my first condo was 1999, 2000, when I started med school. And then back then, 2004, banks were really lending. It was really easy to get a loan. And, on a property 50K, that was kind of a low risk bet. It wasn't like a, 300, 400K, that got a lot of people into trouble. So that was my second unit. But during that process, I also devoted a lot of time to studying equities. And this was, from 2002 to 2006 was a huge bull market. Fed lowered interest rates. There was a lot of speculation, especially in tech. And, I got in at the right time and everything just went up. So I was, buying call options and, I could, make 2K, 10K, 20K. And by over a 4-year period, I had amassed, several hundred K in liquidity. So that was kind of my second income stream was, buying and selling call options and stocks as well. So, caveat is that, during these times you have to, the trend is your friend, but if you go against the trend, like 2008, 2009, you're going to get wrecked. So, I was, fortunate. So bought my second condo, did the same thing, house, rented it out. And
so did you pull your money out of the markets before 08, 09, or you said you kind of went up and then had a little bit of a crash too?
Luckily, so during this time I learned about risk management, and I learned that, during these times I took out 70% of my profits and I let the rest of the 30% ride. So, that 30%, probably dwindled down to 10% or so. So I took that loss. I took it as a learning, really know that markets, can turn. Nothing is forever. And in these markets, you have to be more strategic. So you have to, kind of have a long-term allocation, short-term allocation, take your profits, have short-term positions. It's more of a kind of nimble and more of a trading mindset as well as a long-term investing mindset.
Yeah. But I mean, thankfully you pulled out 70% of it and then used that to go and buy more real estate. Was that kind of the the next step there. Okay.
Yeah. And so, I was really in good position in 2008. So there was another crisis looming, which was the healthcare crisis. And basically private equity was coming in, government mandates. They were basically tearing the whole healthcare system apart. And, I saw a lot of my colleagues really struggle during these times. And so I started looking for the exits, and I was always finding a way to fire my job and how I could quit my job and, set out on my own. This was always in my passion and my goal. And so, luckily 2008, I was so sick of the system. I saw all the executives just take out huge bonuses from the bailout money, funded by the taxpayers. And that really irritated me. So I turned in my keys, badge, and pager, and I was like, I don't want to be a part of this. I don't want to be a part of the healthcare system. And I started investing in single family rentals throughout the Houston area. And by then there was like a 20-30% correction. So,
that was a great time to be buying, man.
Oh man, it's like 2008 all the way up to about 2018 was the best time. Now is like more, I think there's a lot of interest, and, there's more buyers, and it's a more competitive market. So, I was able to buy my financial freedom by 2016, became a multimillionaire, retired early and dedicated to helping physicians.
That's awesome. So in 2008, when you decided to walk away from, medical practice, were you at a point where you would say you were financially free, or you kind of you'd done enough to where you're having success, the trajectory was on the right direction, but you needed to kind of go all in to kind of go to that next level? Or where were you at that point? Because that's kind of an interesting, time frame and understanding, if you're already kind of fully set and you felt like there's no real risk doing this, or it was kind of a risk to jump off.
Yeah, it was actually, so it was one of the biggest gambles I've ever made, but it's one of the biggest gambles that's really paid off in terms of, how much value I've been able to create. So, by then I was, 29 years old. I was financially free, so I wasn't really tied to a job or an income. So, so basically, in order to get to the next level, to become financially free, I had to sever those ties and basically go all in. And that's been one of the hardest decisions, but it's one of the best decisions. And one of the decisions that's really come under criticism from my family, friends, colleagues. They called me, a traitor. They called me, I wasted a lot of time. Of course, I paid for everything. I didn't take any money from anybody. And so, that was my decision, and I have to live with myself. And it's one of the best decisions. So if you, fast forward to today, 15 years later, all of my friends, colleagues who really questioned me back then, they're now asking me like, how did I do it? Can I help them?
They're all listening to your podcast now, right? So, wait, how did Chris do this? I got to figure it out.
Yeah. So yeah, and it's incredible because, when you do something against the grain, people are just like, when something just so against the grain, people think you're either crazy or you're nuts, or you're just something, or you're just going to be a tremendous success. So it's either you're going to be a tremendous failure or a tremendous success when you take these risks and gambles. So
yeah, well, thankfully it paid off. Talk a little bit about kind of mindsets. You said, and right now what you do a lot of times is speaking, right? You're training people through your podcast, through other events of just financial literacy. And what do you find are like the biggest blocks for people to kind of, make the jump? And maybe if it's not even a full, like I'm going all in actively to do real estate full time, but it's even just, I want to go more passively, like in syndications or funds or other things. Like, what do you find are the biggest roadblocks mentally people have in this journey?
So one thing is I separated between internal and external roadblocks. So one thing is external roadblocks those are your friends, your family, your spouse, society, and those are kind of in media as well. And that's really hard. So that's like one of the things where you have to do is you really have to be careful who you associate yourself with, who you spend your time with, who you're influenced by, because in today, in the past, there was like this one path where you had to follow it. And if you got off of it, you were in trouble. But, now we have the internet, we have social media, we can do a lot of different things. We have more options. So that's one thing. So, be careful whose advice you listen to. A lot of friends are well-intentioned, but really don't listen to I have a really great phrase is listen to those who have done what you want to accomplish. And a lot of the haters, yeah. And a lot of the haters and naysayers are such because they haven't done what they say can't be done. So it can be well-intentioned or not. So that's one thing.
It sounds like that was a challenge for you with some of the family expectations and friends of like, hey, what are you doing, right? And so you really, how did you overcome that, block by just finding the people, the mentors, whether they were, in person or you just listened to like Robert Kiyosaki's book, or how did you overcome that? Because it's easy to say, but it's one thing to do it versus to say it.
Yeah. And the internal is really hard. It's super hard because, society is kind of designed to keep everybody in conformity and really nobody should stand out. And so really for, a period of around 8 years before I started to really get traction and success, it was just me in my room. It was basically on med school mode and I basically executed. I networked with entrepreneurs, people that were like-minded, doing things that I wanted to do. And I really just basically shunned mainstream. So I turned off the TV, all my old friends and colleagues, they thought I had, died or dropped off the face of the earth. And I basically, family meetings, outings, I really kept to a minimum. And, if I had to spend time with family, with the naysayers, I would really mentally prepare, prime myself to understand where they were coming from. So that was huge, just basically shutting out all of the noise and just execute. So that was the biggest thing. It was the hardest thing. But now, today, when I get haters and naysayers, does not affect me at all because I know where they're coming from. And, I've been able to see that success. So the one thing is just turn off the noise, really focus on who you associate yourself with.
Yeah, no, I love that. I mean, I think it's so simple, but it's so powerful of, tuning out all the noise, the distractions, the negatives, and focusing on the people that you want to emulate and that you want to model, right? Finding the people that have what you want to go for and modeling that and listening to the advice that, maybe they share or the path that they forged. And I remember doing that when I was back in commercial banking, and it was a great experience, learned a lot, of how to underwrite deals and about real estate and business. But I looked at the people that were 10 years ahead of me and I was like, that is not where I want to be, right? It's a very different path, and, had to make some changes to kind of get to where I wanted to be. And I think takes courage. It takes, going against the grain a lot of times, but obviously paid off well for you. It's paid off well for me. And I'm sure everyone else that has a similar story.
Yeah. It's been a tremendous, and really it's just a story of growth and kind of just, knowing who you are and just kind of setting out on your path. So, I said.
So what was you kind of mentioned with the financial literacy piece, you read the Rich Dad Poor Dad book, and that's a great book. It's, creates some really powerful concepts for people who aren't familiar with, buying assets to generate income to, kind of create this virtuous cycle. But what else did you do to really educate yourself? Because a lot of the things, to your point, that we're kind of taught in the financial world is this, just invest your 401k, set it and forget it, wait till you can retire at, in your 60s, and hopefully you have enough that you can live off of for the rest of your life, right? It's a very different mindset, very different kind of path. But what did you do? Because there is a lot of just education needed as you're kind of making the transition more into especially alternatives or real estate. Even if you're not going full active as an investor, you want to go more passive, what do you recommend for people to kind of, level up their financial literacy?
Oh man, it's so much has progressed these days. My base is, basically, base of reading, but also now they have YouTube and podcasts. So everywhere I'm going, I'm always on the listen. The other thing is plug yourself into communities. So it can be either masterminds, like physical masterminds that you pay for, very valuable. But of course you have to vet these masterminds, and but there's something surrounding yourself with a mastermind that's really powerful. It can motivate you. You can get additional resources that you can't find in books. So the networking as well. So I'd always go to in person. Now I can go on to Zoom as well. Facebook communities. There's a lot of digital communities. So when I first started out, all I did was I got into my car, drove to the library, read for an hour, write down some action steps, really think about those. But now it's like, it's exploded. So now you can surround.
Yeah, you're old school going to the library I mean, that's some commitment right there. I mean, you're right. It's there's so much available at your fingertips right now. It's incredible.
Yeah. But I really think working in masterminds those things can really set yourself up for the next level.
Yeah. I love that. I mean, I agree. I'm in several masterminds myself, and it's just, not only can you rub shoulders with people maybe you couldn't otherwise, but you're also just, having something that's maybe people are a step or two ahead of you and seeing what's possible, right? Just even that awareness of that is really, really powerful too. Let's just go back to kind of more the investing. I want to get more into the nitty gritty here. This is always, the fun part. And, how has your strategy evolved? Because it's early on, it sounds like you're doing the house hacking. You started buying some rentals, obviously great timing to be doing that. And, it never hurts to have some luck on your side when you're investing, right? and timing things well. But how has it shifted over time? Are you still, actively involved in a lot of your deals? Are you kind of more passive now? Have you invested more in kind of syndications and diversified in other asset classes? Talk a little bit about how your strategy has evolved and what your portfolio looks like now.
Yeah. So my strategy has really transitioned from more of an active approach to more of a passive approach. And the reason why I advocate passive is because now I spend a lot of time, speaking and doing consulting and, building out my brand and helping other clients. So that's one of the reasons. And really the active part really taught me the business skills to really succeed, in my current. But allocation wise, it's always been around 45% real estate, 45% equities. And then the rest, the 10% are kind of what I call alternative asset class. It could be syndications, could be digital assets, different opportunities, just kind of increase the upside, So that's kind of how it's transitioned. For the real estate side, for the listeners, it's always been, my bread and butter has always been single family. So, I haven't gone into multifamily or apartments. I've invested some into syndications, not a lot, but that's just more to get exposure to the upside as well as the tax deductions. So it's always been single families. I bought my last final property in 2018. And now I'm just, because of the interest rate variability, the economics, COVID, all of that, I'm waiting for everything to settle down before, diving in again, sitting on, a cash cushion. All my rental properties are managed either passively. And so, that's given me the free time to actually, do my passion work, which is to help others, achieve financial freedom as well. Equity wise, I've always been buying the dips, 2022, 2020, and basically dollar cost averaging as well. Always looking into new opportunities. And then also the digital asset space, which is a really exciting space. I'm carefully looking at that, delving into that. Again, these are more riskier, but they have potentially more upside if you can afford the downside risk.
Yeah. Awesome. Well, thanks for sharing that. So on the 45% of real estate, these are just the historical rentals that you've purchased over time and continue to hold on to. So you don't own those through a syndication, you own those directly, and you probably have property managers and others that run those for you on a day-to-day. Is that accurate?
Yeah.
Okay.
It's all direct active, but it's managed by property managers. So it's more passive. So, and then,
got it.
Yeah. And then go ahead.
On the equities, are you buying like broad-based ETFs? Are you, what's kind of your breakdown strategy there a little bit on if using an advisor to do that, or you kind of just dollar cost averaging is pretty simple. So you're just kind of keeping it simple and, just having, buying when the dips a little bit. So talk about that strategy a little bit.
Yeah. So essentially, I'm a little bit more aggressive. So my equity portfolio is more heavily weighted towards the tech side. So, Amazon, Apple, Google, the reason my thinking is because of the rate of inflation, as well as the rate of debt, as well as the interest rate. So as well as declining GDP. So the reason why a declining GDP is important is because in order to service the debt, the country has to produce something to pay off that debt. But if your GDP is declining along with rising interest rates, more of that's going to be serving the interest rate. So tech is in a great position. I think, Apple, Amazon, these companies are in great positions. They're using artificial intelligence, blockchain. They're doing a lot of things. So the next wave of productivity will be in technology. It has to be. So that's, I'm more weighted towards that. But again, I'm broadly diversified. I have SPY, that's the ETF for the S&P, the QQQ, NASDAQ, as well as the Dow Jones. So, again, broadly diversified, get your base footing, get your safety, and then you can go out and take more riskier bets. So,
yeah, makes sense. I mean, and just by function of the tech companies or the big ones, Apple, Amazon, et cetera, the size of the market caps, they already are pretty heavily weighted in the broad-based exposure as well anyway. But yeah, that makes sense. And I probably agree that, as we continue to have GDP growth, I think most of that growth is probably going to come from productivity versus population, right? Because population, we're still in the positive barely, but most other countries are on the decline. And so to continue to grow, we need to have more productivity, more technology advancements. And I think that's smart. And then on the 10%, kind of break that down a little bit. So it's obviously a small portion. This is probably, like you said, a little more of the riskier assets. You've got digital assets. Is that cryptocurrencies? Is that, break down some of what that 10% is?
Yeah. So 10%. So approximately, so of that 10%, 3 to 4% syndications. That's more to get the active side, passive side. And then, 4% is actually in, it's not in cryptocurrency per se, but it's in Bitcoin. So I always like to distinguish Bitcoin from cryptocurrency. And so the reason why Bitcoin is extremely popular these days is because it's a decentralized digital asset with no counterparty. So it's basically, with governments printing money, excessive debt, bank failures. In the past, gold was a safe haven. Now countries are looking at Bitcoin because it's non-sovereign and it can't be manipulated. I distinguish that from cryptocurrency because cryptocurrency is centralized and there's people behind it, and it can be manipulated. There's rug pulls, there's fraud, there's scams. All of the headlines. So the reason why I really like Bitcoin is because it is a hedge against sovereign defaults, currency debasement and all of that. So that's one of my plays, and we'll see where it goes.
Awesome. Well, let's talk a little bit about just kind of some of the macro trends. So this is kind of where you've built the portfolio to this point. Where are you seeing opportunities? What are you kind of interested in right now? And, you said you haven't really bought any new rentals for a while. So what's kind of your go forward strategy just from an investment standpoint, and where are you seeing opportunities?
Yeah, right now is great time to be in cash. Right now, 4 to 5%, T-bills, a lot of banks are offering, accounts offering that. So if you basically want to sit in cash on the sidelines, 5%, the risk-free rate for doing nothing, that's kind of my default. But then again, again, where I'm looking at is, the next trend. So for example, we talked about demographics, we talked about debt, we talked about aging infrastructure, so political, financial, healthcare, transportation, and education. All these are really in desperate need of a massive upgrade. So, and in that macro environment, we have declining GDP, rising interest rates, cost of living increasing, taxes as well. So what I'm looking at is these early stage companies, blockchain, artificial intelligence, quantum computing, the silicon industry, Web3 and blockchain. So that's where I'm kind of positioning myself. But right now is a great time to be in cash. And then, when you see opportunities, especially in real estate, if the numbers work out, be careful not to buy at the top, and you make sure that the debt service, especially, with these interest rates, the numbers make sense. So that's where I'm kind of positioning myself.
Yeah, got it. Yeah, it's interesting. I might push a little bit on the cash piece, because I think, you have kind of conflicting challenges with inflation, right? Because inflation is eroding the value of cash. And obviously, with the risk-free rate going up, it makes it less erosive. But depending on how you measure inflation and where you think it's going, I think it's good to have cash because one, if we're going into some hiccups and some bumps here economically, which we'll see. I'm still not convinced we are going to have a recession. If we are, it's going to be very deep. But it's good to have buffers. It's good to have cash, but you also don't want to sit on too much cash, right?
Yeah.
Because the future value of your purchasing power is eroded, right? And so I favor more. I mean, you obviously are pretty heavy into real estate already, so that single family especially correlates with inflation pretty well. It's pretty inflation protective. So but for those that are not as heavily into real estate, not as inflation protected, I would say you probably want to be, have a decent percentage of cash, but also have lines of credit, right? For me, cash is kind of cash and cash equivalents, where if you have lines of credit open where you can, have those available. Obviously, there's a chance that banks can take those away if things get really, really bad. So you don't want to overly rely on that, but, have access to cash where you can. And I would push a little bit more on the investment side of getting into inflation protected investments that are conservative if you are more risk averse. But inflation is enemy of savers right now.
Yeah, totally agree. And then basically, you're sitting on cash, and it's kind of like a short term holding. And when you see, for example, dips in the market, or you see a great investment, especially single families, it's a great time. So, and again, they say cash is king. So, like, as long as in lines of credit as well, that's always helpful.
Yeah. Awesome. So what are you kind of positioning for me? I know a lot of people have lots of different opinions about where we're at, right? We have high inflation and we have higher interest rates. Maybe it's going to last a little longer than people would want originally, but it's kind of funny too. Like, all these different headlines of, we're about to have this huge crash. And I just saw yesterday, as we're at this recording, we hit $1 trillion of credit card debt. We're about to just implode as a country. But you have to look at the whole picture, right? And so many times, like, the headlines are just looking at one data point and not looking at it relative to other data points. And sure, that's a big number, but it's actually, as a percent of total savings of a consumer, it's the lowest that has been in 20 years. Right. So even though we have higher credit card debt, it's only 20% of total savings of consumers. And so we actually have $5 trillion of excess savings on consumers' balance sheets. Right. So it's, to me, there's these, we're hitting some speed bumps, but we've got a lot of strength in the underlying economy and a lot of cash on the sidelines. So, I mean, what's your expectation? I mean, if there are deals to be had, are you expecting a correction, or what's kind of your thought from jumping back in and buying more single family?
Yeah, it's a really fine line. It's a really fine balance because there's so much conflicting data. My after talking to individuals such as yourself and other investors is so from 2009 to around 2022, basically it was basically Bernanke. They reset the interest rates to zero basically, and basically we're in a zero interest rate environment. And now I think that that's done, they're going back to this 5%. So a lot of people say the Fed is going to cut, but I personally think that they're going to keep interest rates in that ballpark for a much longer time, unless we have something like a Lehman or another COVID or some big crisis. They're always talking about the unemployment numbers. And the economy is strong. I mean, they talked about why is the Fed raising rates with consumer spending. So I think people are going to adjust to this new environment. One thing is that's on my radar is basically with the real estate, which is why I'm a little bit more cautious, is because with single families, everybody's going to buy a home. You have to avoid overinflated, overheated markets. But is with this work from home and this remote work, I think commercial real estate is something to keep an eye on. And, a lot of, spaces in San Francisco and New York City, their offices are empty, and so that's something to keep an eye on. And, especially in this high interest rate environment. So that's could be the next domino to fall. I'm not sure, but, that's something to keep an eye on.
Yeah, absolutely. I think commercial real estate has some headwinds, it's important to distinguish what asset classes in commercial real estate, right? Because people lump it all together, but the real big challenging one is going to be office, right? People just don't know where that's going to land, and especially in these big metros on the coast that people have, largely have kind of migrated to more kind of southern states and other places. Maybe we're having going back to work movement, but most estimates are saying that we're only 50% of where we were pre-pandemic, right? From an office occupancy standpoint. And so I think the big question is what happens, right? What happens to office? I saw an article today on, some initiatives where they might try and create some incentives. Like in San Francisco is a great example of converting some of these offices into multifamily housing, right? And they're in, great areas a lot of times, close to, good jobs. And so it could be a use for that, but it's still kind of early. It still remains to be seen. But multifamily, I think has some headwinds, but more of the headwinds I think are going to be related to some of the debt challenges, maturing debt that enabled a lot of these properties to be purchased a little too aggressively. But at the same time, we have a huge housing shortage that's not being solved anytime soon. Long-term trends are very supportive of anything housing related. So yeah, it's going to be interesting. I'm not as bearish as some people are, and I just because I know how much is on the sidelines, both from consumers and from a lot of these big REITs and some of the biggest funds I've ever raised for real estate, right? So there's still a lot of pressure on the demand side from an investment standpoint, and we still have a pretty strong economy, right? I mean, I'm kind of with you. I think there's going to be kind of this muddle through where we have, these two competing forces. We have higher interest rates, which is putting pressure on asset prices. We have a little bit higher inflation, and it's just kind of threading the needle here to, make it through. But yeah, I mean, we're still looking for opportunities because I think there's going to be some good opportunities over the next 12 to 18 months for sure.
Yeah, especially the investors that got in at the peak, and then now they're not getting cash flow, and their valuations are down. They can't refinance. There's a couple of my investor friends, they've picked up some properties, from there. So I was talking with another investor on my podcast the other day, and he was basically saying, the numbers still work out. The cap rates are a little bit less, than 10% or whatnot. But, as long as he's holding it for long term, he's quote, not concerned. But again, that's not advice, but, your margins may be less, but as long as you're investing for cash flow and for long term, you should be okay. So there's always opportunities. You have to just be more strategic and, pick your fights and your battles appropriately.
Yeah, absolutely. Absolutely. Well, Chris, this has been really fun. Thanks for sharing some of the kind of nitty gritty and all that. And just like, what would be kind of your final advice for those that are on the sidelines, whether they want to invest passively or actively, and, just can't make the leap yet? What would you say is kind of that first step to take?
Oh man, just start. I mean, start and just listening to podcasts and start, listening to YouTube, watching YouTube channels, and picking up books and start asking questions. Start plugging yourself into networks. Go to conferences, investor conferences. Invest in yourself, and then spend the time to learn it. And that way, when the time comes, you can, when the right opportunity comes, you can pounce on it. So really invest in yourself during this time, invest in your education. I mean, the internet is basically, now it's not an age of, now we have to enter in the age of transformation. So you basically take the knowledge and information and assimilate it and apply it and use it appropriately. So information is everywhere these days. So
yeah, I love it. Well, what's the best way for folks to kind of get connected with you? Tell them about the podcast and the things that they can do to learn more about what you're doing?
Yeah, they can check out my podcast. It's on Apple, Spotify. It's on all major platforms. It's Financial Freedom for Physicians with Dr. Christopher Liu. It's there. I'm on LinkedIn, Instagram, Twitter, TikTok, as well as Facebook. And we have a growing community. You can email me at chris@drdrchris.com. chrisloomdphd.com.
Awesome. Well, thanks so much, Chris. It was really fun having you on and sharing your wisdom.
Thanks, man. I really enjoyed it.